Sanjay Dutt joins us now. Let's take our conversation forward. Sanjay, good morning. Thank you for joining us. I've heard it's quite chilly and the Delhi winter is at its peak. So, how are things there with you?
You can see me all, dressed up with a warm muffler around my neck. I think the only worry that I have is that the winter cold shouldn't hit the markets because at the moment they're hot and in action. So otherwise, I think markets are behaving pretty positively for investors after a long time. And on balance, I think what we are seeing in the last 2-3 days, this correction that set in, some kind of consolidation, some kind of deep cuts in select stocks, is pretty good to shake out the weak hands to give people a reality check.
Sanjay, would you be dismissive of a lot of brokerages who are now saying that we like the economy, but markets are already factoring in a strong economic recovery? From Ruchir Sharma to CLSA, from Citibank to BofA ML, the universal view is that markets are pricing in a strong economic recovery which will happen this year and next year, and stocks are trading at a valuation from where near-term returns should not be expected.
On a broader gauge, if you probably look at the Nifty or some of the indices or in fact some of the sector indices, I agree with that. But to say that there are opportunities in the market, I think still there are a lot of opportunities in the market. Nifty, you may not see another 10 or 20% rise over the next 12 to 18 months. It seems difficult actually. But I think there's a lot of opportunity in select stocks and select sectors, particularly economy-facing cyclicals, manufacturing, select PSU plays, where there are expectations that government may take some serious steps over the next 2 years in either privatizing them or making them more efficient. We're already seeing some first signs of that. So to cut a long story short, I do agree with most of the observations made by research houses that markets are more or less pricing in everything. But to say that there are no opportunity in the market, I think there are a lot of opportunity in the market still to make money. It's just that it's getting difficult to find them and to really go into depth and understand as to what kind of growth they will give out and how much of the growth already is in the price.
An ordinary investor do? If you're putting money in mutual funds are underperforming the Nifty. Ordinary investors do not have the finesse or the understanding of being stock-specific experts because of lack of awareness or the ability. So how should one go about approaching this market? Because we definitely are in a bull run. In a bull run, it is important to participate, but if you're participating via the mutual fund route, the returns have not been very gratifying.
I don't think we can really pass a verdict on the mutual fund returns over the last year or two. Most of the mutual fund money normally can only be evaluated on a longer time frame. Yes, the past 5-6 years haven't been good, but for various reasons. But I'm reasonably confident that even if lay investors, small investors who don't understand the intricacies of individual stock and sector analysis, they should continue to do their SIPs. Yes, they can take selective calls on some of the funds where to invest and where not to invest. Funds that are kind of exposed to the economy, exposed to cyclicals, exposed to domestic inward stocks, they could probably increase allocation there. And funds that are kind of exposed to the, much higher and much overvalued kind of growth stories, they could probably avoid those. That's very easy to kind of evaluate by looking at the fund's portfolio. So that's what my recommendation would be, is that be selective on the mutual funds, but don't worry or don't evaluate them over the last year or two, because last year or two have been pretty rough for the fund managers. It's not been easy to make money, but I'm reasonably confident that most top 5-10 funds would perform very well in the next 5 odd years. Yeah.
Okay. We're counting down to budget, Sanjay. There's been all this upbeat sentiment on, consumption and demand coming back and things really getting back on track. What would be your, in terms of your strategy going forward, would it still be focusing on the cyclicals with an eye to recovery, or do you feel consumption will actually be faster to the chase?
No, I would focus on cyclicals. And I have been positioned for the last about 6-8 months on cyclicals and domestic-facing stocks. Domestic-facing in the sense, of course, consumption is also domestic-facing. Domestic-facing in the sense that particularly in the infra, steel, cement, these kind of, places. Because I think the only way out for the governments and for everyone here in a country like India is to aggressive public expenditure. And I also am of the opinion that in the next 12 months, the capex cycle will also show revival. Because according to me, the single most important factor that's going to benefit the economy are the lower interest rates. We're already seeing the impact, and we're hearing positive news from some of the housing finance companies. We heard a lot of, positive talk from the managers at HDFC. For instance, they are seeing that demand starting to pick up at the lower end of the market. So I think as interest rates fall, the costs for all companies who are into manufacturing, who need working capital, their costs are going to come down, margins are going to improve. At the consumer level also, the average EMI is going to come down substantially. And I think lower interest rates are here to say, yeah, we can worry about inflation and, 25, 50 basis points up and down in the interest rates over the next 2 or 3 years. But I don't think anything more than that. I don't see inflation really a big headache over the next 24 months for the RBI governor.
Fair enough. And Sanjay, then even if we look within that now on the financials, I want to get your view, because there seemed to be a suggestion that perhaps we should get used to this new normal from the financial basket. Maybe we wouldn't see outperformance in that same time period that you're suggesting. What's your take?
I think financials is a very tricky space because, I don't have the conviction to take a call on buying an HDFC at, times book it's trading right now. I would be quite skeptical, but markets are markets, prices are prices. People are buying into them, and I personally would want to be underweight, private sector financials which are so overvalued. I'm in fact positioned more towards the likes of State Bank of India, etc. I think that if you're betting on the economy, there's no reason why good quality PSU banks will not start doing well over the next 2 to 3 years, because a lot of cleanup has taken place. Yes, you could say that some more NPAs would be down the line because of the COVID impact and the moratorium, etc. But I'm a tad worried about investing in the likes of Kotak and HDFC Bank. Not taking away the fact that they are phenomenally good, well-managed companies. They've been delivering quarter on quarter, and whenever you bet against them, you go wrong. But I would still avoid kind of being invested in them because they're not my cup of tea as such.
Sanjay, I saw you retweeting a view on Reliance the other day, saying that it has a return on equity of barely 9%, which does not even cover the cost of equity. And the ROE, despite significant profit growth projections, is still expected to be only 10 to 11% over the next 2 years. How does it all tie in with investment into Reliance?
Well, good question you asked, Aisha, because, I think at this point of time, particularly in the 1900, 2200 range where Reliance is trading, I think it's got most of the positives priced in, particularly because, some of the platform businesses where there'll be a lot of excitement and why it got re-rated, those businesses are going to take a substantially long period of time to actually see cash coming in and to actually see, positive returns on capital coming in. They would burn a good amount of capital. And I see, in fact, the petrochemicals business is exactly where the ROE and all those things have been coming out from. even the petrochemicals business doesn't seem that robust enough right now to actually carry the stock any further from the current levels. So I personally feel that it's in the upper end of the range. Longer term, yes. Once we have this whole unlocking story, and if we have demerger into various verticals or separate listed companies, whether it is retail or whether it is geo, IPO, whatever is being talked about, we may have some upside coming in there. But as it stands right now, I think plus minus 10 or 15% range is all that Reliance has to offer, in my opinion, over the next 12 months.
Sanjay, you've been a keen observer of how AI ties into the entire healthcare and its ancillary space. Out of insurance, hospitals, drug companies, diagnostics, which one would assume are still at a very nascent stage when it comes to India, where do you think does lie the opportunity for not just the short term, but the next, say, 2 to 5 years?
One priority in the broad, healthcare space, if you put it, would be diagnostic, because I think diagnostics has phenomenal potential. Because if you tag this with insurance and if you tag this with other, issues that we've had lately, particularly into COVID, people are more and more going to get inclined to ensuring that, they get timely health checkups, they get timely, tests done. And in any case, we are seeing healthcare in India evolving in such a manner that even the professionals are involved. Unlike the past, when we went to a physician or anyone, he would first land up just prescribing you a simple medicine and then say, come back after a week. That whole methodology has changed completely. As soon as you land up with a physician or a specialist, the first thing before he actually lands up doing anything is he definitely 8 on 10 would give you some tests to get done. So I think diagnostics is a very big market in India. It will continue to grow. Some of the existing players will really become big. Some more new players will come in. And it isn't that capital intensive as compared to hospitals, etc. It's more a logistics-oriented business. And of course, there is a phenomenal amount of mechanization, automation, technology that's come into this business. So that's where I would like to be. But I think overall, healthcare theme is very positive. After that, I think insurance is a big bet. So diagnostic, along with insurance, I think is the biggest opportunity in the healthcare space. Hospitals, yes, but then with hospitals, we land up with the usual problem of being a very capital-intensive business, and it requires huge amount of investments, which take a long time to give returns. It's something kind of similar to hospitality in the tourism business. May not be as bad, but still it does require a huge amount of capital. So to cut a long story short, I think if you want to take exposure to the healthcare segment, I would be into diagnostics and insurance. And of course, we have individual pharma companies which are way ahead. And if you want to bring them also into it, then select pharmaceutical companies.
Sanjay, if there is any tinkering on direct taxes, whether there is a COVID cess or some tinkering on super rich in terms of the total taxes, could that be a disturbing moment for the market? So the real net impact for the economy if you tax super rich may not be large. But do you think in terms of a sentiment dampener, directionally that could disturb the market?
I don't think directionally it would disturb it. It would be a blip. Ultimately, it's all got to do with how the economy picks up and how earnings pick up and how companies perform. It's something like what happened when we had that LTCG problem. We lived with it for a few months, and after that, we all got back our focus onto individual companies and opportunities. And similarly, if you look at how the manufacturing companies tax cut that happened in September 2019, today we've forgotten about it, but it's a very huge step that happened. So it'll be one of those kind of blips we'll see in the manufacturing companies' tax benefits, tax reduction. In fact, we saw a huge rally in about a week or so. Then after that, we got involved into a lot of other things relating to the economy and how things are slowing down, and then followed by COVID, etc. Similarly, the LTCG thing, same thing happened. So I would kind of mirror that to if anything of this sort happens here also. Because fundamentally, we need to understand a very important thing that as time is passing by in India, investors are left with no other option but to take exposure to equities. And that exposure to equities, whether through investments in mutual funds or directly, will have to increase because returns from other avenues are more or less, gone. Because even if you go back and put money in a fixed deposit, you don't get anything out of it post-tax. And even other places, people do not want to take any risks on NCDs and those kind of, in fact, people are averse to debt investments into mutual fund also after some of the incidents. So equity allocations would keep rising. And if equity allocations are going to rise, we're definitely going to have better times in the markets for the next few years. And followed by, of course, the EM allocations that I think are going to be huge over the next few years into India.
Sanjay, if one looks at the news which is out there about which companies would go public, apart from the government disinvestment, there are a lot of internet companies or e-commerce companies which will perhaps go public in 2021, whether it's Nykaa or Policy Bazaar, somewhere it could be Zomato. How do you propose one should bet on that theme? Because that's the new age business. That's where all the action, excitement and attention is.
I think it's near impossible to get the right valuation metrics for these companies because most of these companies tend to burn a huge amount of cash in the initial phases, which they are right now. We know companies like Zomato and all the kind of cash they're burning. But the bet you always make is that who's going to be the winner amongst them all in their particular segment. Because eventually, after a few years of cash burn or many years of cash burn, the leader finally starts raking in the profits. So in the IPO frenzy, they would obviously be lapped up. No one looks at cash flows or anything. We kind of have a tendency in India to, if it's an IPO, we just kind of all want to, have a piece of that cake and probably trade that pop 90% of us. So these IPOs would definitely be absorbed very easily by the market. There is enough liquidity in the system. Sustainability is the whole question. It's like what we are seeing in Burger King, the kind of prices we saw, the kind of volatility we've seen in just short span of a few weeks. So exactly the same thing I think we would see in some of the internet companies. But yes, they are very exciting businesses. You need to evaluate them carefully, and some of them you may need to have them in your portfolio for a longer term holding, 5-10 years. Something like a Zomato, I'm very optimistic on the way the business model is rolling out. It's going to burn cash. It's going to be a real roller coaster ride. If I do get an allotment and I buy it. But in the end, I think the business has got potential. The team has got a phenomenal amount of, execution capabilities. They've understood the business. So there I would invest, no doubt about it. But it's a different ballgame altogether. And we've seen in the West also, it's not easy to get investments into new tech companies, right? And particularly these kind of companies.
Sanjay, historically the sweet spot where you've done treasure hunting are companies which are in the range of market cap between 2,500 crore to about $1 billion. Where are you treasure hunting in that semi-mid cap or the small cap pond?
Well, there are a large number, in fact, because I think it's a good time to look at the textile sector. There are a lot of companies in the textile sector, maybe even lower than that 2,500 crore market cap. Because I think that's one sector which the government will focus on. Plus, it's coming out of a long cycle of mess and a lot of problems. That's one place I'm looking at opportunities there. I've always maintained that within that 2,500, 10,000 crores, there are a large number of second-tier steel companies, which I think over the next year or two would give good returns. I'm a believer that metals has more steam to go with a pullback. Similarly, there are a good amount of manufacturing companies, which are again in that bracket, in the second-tier manufacturing companies, but belonging to good, well-established families. If you go back and see, you will be able to find many of them in cement, in ancillaries, in a lot of other places. Also, the huge basket available in that space. I can easily list out 50 to 100 companies worth evaluating and considering, which will give you a good entry opportunity if the market corrects. So that's exactly where I started my conversation when you mentioned that a lot of large broking houses are, saying the recovery is priced in. I think these are the pockets of these smaller companies which are still off radar, and people aren't focusing on them. This is the place where investors need to be. But obviously, this is a difficult space because you need to do a lot of homework and understand things, read annual reports, read a lot of research reports. It's not easy to really get the next 2x or 3x stock within this universe.
Okay, what's the clear avoid, Sanjay? What would you completely stay out of? We've spoken a lot about, of course, the pockets of activity or where you're seeing potential. What would be a clear avoid?
There wouldn't be anything that's clear avoid. All portfolios normally have underweight and overweight positions. But I would, at this point of time, contrary to contrary to consensus on the street, would be a little wary of some of the IT companies who started to trade at 30 multiples, closer to 30 multiples. I think they're priced in quite a bit, so I would be underweight there for the time being. Similarly, I think a lot of, branded consumer plays, there also, I think those companies have gone and now trading in the multiples of 50, 70 or more. Even there, I would be underweight for the time being. I think those are the two places, like I said, I wouldn't avoid, but I would be having very little exposure in my portfolio.
And, while we've been looking at perhaps moderate corrections, although the overall outlook continues to look very positive, particularly with the kind of flows we're anticipating, what's a realistic, return expectation or a year-end kind of target that an investor can keep in mind? What would be realistic?
I think if you're just looking at the indices, if you're smart enough to just sit aside and get in when there's a deep cut in the market, you obviously can't get it at the bottom. Deep cut, I mean the market falls about 5-8%, and even if you got in when it fell about 4 or 6%, there's a good chance of making a 15% return from that level. But I think timing has become very tricky now because indices have rallied a lot. Like we started our conversation, they have built in most of the positives already. So if you were to take a call on a return based on purely indices, it's a very difficult task to do. Therefore, market timing becomes very critical. But I would, on the other hand, advocate timing in the market and not market timing. That is, get your right stocks, stay put in them for next 2 to 3 years or 4 years, and then you'll make good return. But trying to game as to what is your entry point and when you can sell, I think it's a mug's game because it's very difficult to game that correct entry point, because when it starts to fall or when it starts to go up, you are going to have these aggressive, volatile moves in the market. And most of them are a function of things other than domestic happenings because of the, dollar index, because of EM flows and a lot of other combinations that are playing out, which are near impossible for even someone like us who've been in the markets for decades to really game an entry level when it comes to indices. So I would, to cut a long story short, let's just stick to good quality stocks, which you understand, hold them in your portfolio, write them out over the next 3-5 years, you'll make good money. But if you're going to get too cute to game an entry or exit into based on an index, I think then you're a trader, basically. You're trying to kind of, like they say in Hindi, andhere mein lathi. So you get it right once, you get it wrong. So you just kind of get sucked into this whole index.
Right. All right. Sanjay, appreciate your time. Stay safe, and in Delhi, stay warm.